Today, I want to talk about timing, specifically where we are in the consolidation cycle of the FBO market and what that means for investors evaluating the opportunity right now. Because timing matters enormously in emerging asset class investing, and understanding where we are in the cycle is essential to making a well-informed decision. The FBO consolidation story actually follows a pattern that students of infrastructure investing will recognize from other asset classes. You get a first wave of consolidation at the top of the market. The largest, highest traffic, highest cash flow assets get aggregated into national platforms. Then institutional capital turns its attention to the second tier, which still offers attractive returns but requires more operational sophistication and more sector-specific expertise to unlock value. And in FBOs, the first wave is clearly underway. Signature Aviation, over 200 locations, Atlantic Aviation, a national network backed by KKR, Apollo's modern aviation platform growing rapidly, Bain Capital entering the sector in January 2026. The first wave of institutional consolidation has established the large national platforms. That chapter is largely written. But the second chapter, regional and secondary market consolidation, is just beginning. The airports we were focused on in DFW and Orlando are not on the Signature Aviation acquisition radar. They're too small individually, too operationally specific, and too relationship dependent for the mega platforms to pursue efficiently. But collectively, a portfolio of well-chosen positions at 6, 8, 10 supply-constrained regional airports constitutes exactly the kind of platform that becomes attractive to those mega platforms as they look for ways to extend their geographic reach. NATA's Aviation Business Journal made this point explicitly, noting that private equity, quote, will ensure the growth of untapped new markets as some of their larger public corporations may be slow to venture into new opportunities. There's an important acknowledgement in that observation. The largely public traded FBO networks, Signature, Atlantic, are sometimes constrained in their ability to move quickly into smaller emerging markets by the governance requirements of their size and structure. Emerging managers with regional expertise and operational flexibility can move faster and build positions at more attractive valuations. The analogy I'd use is the industrial real estate market in the early 2010s. When e-commerce first started driving warehouse demand, the largest REITs were focused on major distribution hubs, Los Angeles, Chicago, New Jersey. The regional markets, secondary cities, suburb, industrial parks, hadn't been fully bid up yet. The investors who recognized those regional markets as the next wave of industrial demand and built positions there in 2012 and 2013 generated exceptional returns when the national platforms eventually came to acquire them in 2016 and 2017. That's the parallel we're drawing to today's regional FBO market. The window isn't permanent. I want to be direct about that. Every quarter that passes, the larger platforms are casting wider nets. Every successful regional FBO acquisition that gets announced signals to the next buyer that the market is there. The entry valuations available today, reflecting current seller profiles of family-owned or regionally focused operators who may not have optimized their assets for institutional sale, will not be available indefinitely. The window is measured in years, not decades, and that's precisely why the timing question matters so much for an investor evaluating this space right now.